Do you want to make money without having to sell anything, without having to watch the market every day, and best of all, without taking big risks? SCHD might be exactly what you're looking for. While many dividend ETFs promise stable returns, few deliver the consistency and security that investors truly need. But is SCHD the best option for generating passive income in 2025? Stay with me until the end, because in this video, I'll show you why SCHD has become one of the most sought-after ETFs for those who want to live off dividends. We'll talk about its returns, its solidity, and how it can transform your investment strategy. If you're looking for security and good dividends without complications, this video is for you. In recent years, the search for passive income has become a top priority for investors of all ages. Who wouldn't want to receive a constant cash flow without having to sell assets or take big risks? And this is exactly where dividend ETFs come in. They are a powerful alternative for those seeking stability and recurring payments. But are all dividend ETFs the same? Today, we'll dissect SCHD, understand its strategy, and see if it really delivers what it promises. SCHD, or Schwab U.S. Dividend Equity ETF, is an exchange-traded fund focused on companies that pay consistent dividends. Unlike other options, it selects companies with a strong history of dividend payments and growth. But not just any company makes it into SCHD. The ETF uses strict criteria, analyzing not only the dividends paid, but also the quality of the company's fundamentals. Unstable companies, or those that might cut dividends, are left out. With this, SCHD has built a robust portfolio, including giants like PepsiCo, Texas Instruments, and Coca-Cola. Now, you might be wondering, but does SCHD really generate good returns? Let's look at the numbers. Over the past 10 years, SCHD has delivered impressive performance, outperforming many other dividend ETFs. Its average yield ranges from 3.5% to 4% per year, in addition to stock price appreciation. This means that, besides the dividends, your capital also appreciates over time. And here's an interesting fact. If you had invested $10,000 in SCHD 5 years ago, today you would have a return of over $15,000, considering reinvested dividends. This shows that it not only pays well, but also grows over time. Now, let's talk about the 5 main benefits that make SCHD one of the best choices for those seeking passive income. The first point is the consistency of dividends. SCHD pays quarterly dividends and has historically increased these payments year after year. Second, we have low volatility, as it selects solid companies, which reduces the impact of major market downturns. The third benefit is automatic diversification, since the ETF already picks the best companies for you. Fourth, we have low fees, with a management fee at just 0.06%, much lower than active funds. And lastly, automatic reinvestment, where you can reinvest dividends to accelerate your wealth growth. But it's not all perfect. SCHD also has some drawbacks that we need to consider. First, it may deliver lower returns in bull markets compared to growth-focused ETFs like QQQ. Additionally, its exposure is limited, as it avoids sectors like technology and startups, which can have significant appreciation. Another point is that, despite its stability, no ETF is risk-free. If the companies within SCHD start cutting dividends or face financial crises, the ETF's yield may decline. Now, how can SCHD fit into a balanced portfolio? Here's a strategy. If you seek security and want to build a stable passive income, you can allocate a portion of your portfolio to SCHD and combine it with growth ETFs like VOO or QQQ to balance profitability and security. A practical example. If you have $50,000 to invest, you could put 40% in SCHD for dividends, 40% in a growth ETF, and 20% in bonds for protection. This combination ensures healthy growth while generating passive income. The Schwab U.S. Dividend Equity ETF, SCHD, was launched in 2011 with the goal of providing investors with a steady stream of passive income through shares of companies with a strong history of dividend payments. The ETF quickly stood out in the market because its strategy focuses not only on dividends but also on the quality of the selected companies. Over the past decade, SCHD has gone through various economic cycles, including the 2008 crisis, the 2020 pandemic, and rising inflation in 2022. In each of these periods, The ETF demonstrated resilience, maintaining or even increasing dividends paid to investors. A clear example was in 2020 when many companies reduced or suspended dividends due to the pandemic. But SCHD managed to sustain continuous growth since its holdings were mostly well-established companies. SCHD's evolution can also be seen in its asset growth, which went from just a few $billion in its early years to over $50 billion in assets under management in 2024. This demonstrates growing investor confidence in the ETF. How does SCHD select its companies? What's behind the strategy? Unlike other dividend ETFs that simply invest in the highest paying companies, SCHD uses a more refined approach, prioritizing the quality of the selected companies. It follows a specific index, the Dow Jones U.S. Dividend 100 Index, which is strict criteria. Companies must have at least 10 consecutive years of dividend payments. Factors such as profitability, free cash flow, and dividend growth are evaluated. Companies are ranked based on fundamental multiples, such as ROE, return on equity, and ROA, return on assets. This means SCHD doesn't just invest in companies that temporarily pay high dividends, but rather in those that can sustain and increase payments over time. For example, some of the top companies in SCHD today include PepsiCo, Coca-Cola, Texas Instruments, and Home Depot, all known for strong dividend growth histories. The power of reinvesting dividends. Reinvesting dividends can significantly increase returns over time. Here's a practical example. An investor who bought $10,000 in SCHD 10 years ago without reinvesting dividends would have about $25,000 today. If they had reinvested the dividends, the value would have grown to $33,000. This happens due to the power of compound interest. The longer dividends are reinvested, the greater the capital growth over the long term. Diversified portfolio can reduce risks and maximize returns. SCHD can be an excellent foundation for passive income portfolios. An example of a diversified portfolio. 50% SCHD, consistent dividends and quality. 30% VOO, exposure to the S&P 500 for growth. 10% Treasury bonds, security and protection against crises. 10% JEPI, higher dividend yield to strengthen passive income. This allocation balances growth and income generation, ensuring stability in different economic scenarios. SCHD dividends can be affected by factors such as high inflation. Companies with reduced margins may pay lower dividends. High interest rates. Some companies may prioritize debt payments over dividends. Recessions. Weaker companies may cut dividends. An example was 2022 to 2023 when inflation skyrocketed, and some SCHD companies had to temporarily reduce their dividends. The biggest mistakes when investing in SCHD and how to avoid them. Some common mistakes include buying just for the yield. It's essential to evaluate the quality of the ETF's companies. Expecting quick returns. SCHD works best in the long term. Not reinvesting dividends. This limits capital growth potential. Avoiding these mistakes helps investors maximize their gains with SCHD. Is SCHD a good investment for retirement? For retirement, SCHD can generate a reliable passive income. Here's an example. An investor who accumulated $500,000 in SCHD will receive approximately $20,000 per year in dividends, considering an average yield of 4%. This can supplement retirement income without selling assets. SCHD can be a key pillar for those looking to live off dividends. The future of SCHD. Will this ETF continue to be a good option? Factors that may impact SCHD's future. Changes in the index. Companies may be removed or added. Changes in companies' dividend policies. Some may reduce payouts. New competing ETFs. Alternatives may emerge in the market. Despite the challenges, SCHD has a strong track record and remains one of the best dividend ETFs. An investor can build a solid strategy by combining different dividend ETFs. 40% SCHD, growth and stability. 30% JEPI, higher monthly income. 30% VNQ, exposure to real estate and dividends. This allows for diversification and reliable passive income, ideal for those who want to live off dividends without selecting individual stocks. John Peterson's story. how he retired early with SCHD. In 2015, John Peterson, a 38-year-old mechanical engineer living in Austin, Texas, began worrying about his retirement. He always had a good salary, but never managed to save enough. His biggest fear was being stuck working forever, unable to retire before 65. Everything changed during a dinner with friends when he heard about Dividend ETFs. A colleague mentioned he invested in SCHD and other ETFs, generating a growing passive income every year. John was intrigued and decided to dive deeper into the topic. After months of research, John developed a simple and efficient plan. 40% in SCHD, sustainable growth and solid dividends. 30% in JEPI, monthly payments to accelerate his passive income. 30% in VNQ, exposure to the real estate sector and consistent dividends. He decided to invest $2,500 per month and reinvest all dividends. His goal? To build at least $40,000 per year in passive income within 10 years. At first, the results seemed slow. In 2016, he received just $1,200 in dividends for the entire year. Not even enough to cover a single credit card bill. But John kept investing consistently. In 2018, something magical started happening. His investments grew, and dividends increased on their own. Instead of $1,200 per year, he was now earning $5,000. When the 2020 pandemic hit, the market plummeted. Many investors panicked, but John kept buying ETFs at low prices. As a result, by 2022, he was already earning $18,000 per year in dividends. By 2024, less than 10 years after starting his plan, John reached his big goal, $42,500 per year in passive dividends, enough to cover all his essential expenses. He made the decision he had always dreamed of. He quit his job and started living off passive income. Today, he only works on projects he enjoys, without the pressure of a traditional job. When people ask him for his secret, John always says, discipline, invest regularly, no matter what happens in the market. Reinvestment, always reinvest dividends to accelerate growth. Patience, he waited for the magic of compound interest to work. John proves that anyone can achieve financial freedom with a solid and consistent plan. If he did it, why can't you? Is SCHD worth investing in for 2025? Based on historical performance, the stability of the companies included in the ETF, and the growing demand for passive income, SCHD remains an excellent option for investors seeking stability and strong dividends. However, it's crucial to understand your investor profile. If you want high short-term returns and are willing to take risks, a growth ETF might make more sense. But if your priority is to build a reliable source of passive income, SCHD could be one of the best investments available today. Now, I want to know your opinion. Are you already investing in SCHD, or do you plan to start in 2025? Leave your comment below. And if this video helped you, don't forget to like and share it with more people who want to build passive income. Oh! And if you haven't subscribed to the channel yet, hit the subscribe button now and turn on notifications so you don't miss our next investment videos. See you in the next video.